Good morning, listeners. Welcome to another awesome episode of Dollars with Sense. I'm your host, Ella Lang.
And I'm Terence Woude. Good morning. This episode is about a topic most of us don't want to think about: insurance. But it's a very important topic, and one that we as financial planners consider to be the cornerstone of comprehensive financial planning.
That's right, Terence. We care very much about the various major protection issues and needs facing younger Canadians, specifically those entering their prime earning years who have young families to support and take care of. So today we'll cover the main protection issues you face. In essence, we will discuss how insurance works, how it protects you and your family as well as your finances should you die prematurely, become disabled, or face a life-altering illness. Think of it like your own personal superhero stepping in when times gets tough. You're listening to Dollars with Sense. We'll be right back.
Welcome back to Insurance, your personal superhero. Today's discussion is around the three important protection issues facing Canadians who need to protect themselves from a sickness or an accident through disability insurance, to protect themselves from a life-altering illness through critical illness insurance, and to protect themselves from premature death through life insurance. Ella, why don't you start us off?
You got it. So I'm going to refer to a chart now we've titled the Risk Management Framework to illustrate how these three insurances we're talking about these three insurances: disability, critical illness, and life insurance, fit into our lives where we need the most protection. So when you go onto our Facebook page, Dollars with Sense, you'll be able to refer to the chart within our podcast and certainly our transcript. The framework demonstrates that throughout one's life, you need both income and asset protection. Layered over this are the risk protection products: critical illness, disability, long-term care, and term and permanent insurance. It's a lot there. In your early years, your primary risk is a loss of income. So you'll see the grid where it's in blue. As you convert your human capital, or your ability to earn an income, into financial capital, your risk profile changes to asset protection. That's the bottom blue layer.
Here's where you consider critical illness insurance. This insurance provides a one-time cash benefit in the event that you are diagnosed with and survive the waiting period, typically 30 days, for one of the covered conditions. In other words, if you are diagnosed with cancer and survive for 30 days, then the critical illness policy value will be paid out to you in a lump sum. Based on the claims of the insurance companies that we use, the most common critical illnesses are cancer, heart attack, and stroke. The cash benefit, as I said, allows you to focus on your recovery by providing funds to cover such things as your monthly mortgage payment, additional expenses you may incur, such as additional childcare or medical expenses not covered by a healthcare plan, and even a portion of your spouse's income. Your need is the highest between ages 40 and 55, although you may consider purchasing this coverage when you are younger or older.
Next on that chart, you'll see long-term disability. So long-term disability provides a monthly benefit to replace your income if you're disabled and unable to work. This insurance is needed while you are gainfully employed. Often people are covered through group insurance, but it's important you understand any limitations on your group coverage, and owning personal coverage may be a good decision. If you leave your job, you leave your group insurance. So consider taking a minimum offered with your group and obtain the necessary with a personal disability insurance. At a time when the flow of regular income is disrupted by the disability, how are you likely to cope with a new additional expense? How, and more importantly, when would you begin to even think about retiring planning in case of a disability, and if that's long term? Dip into your savings? You take out a personal loan or mortgage your home? Are you going to borrow from your family?
Well, these might be options for some. Let's look at what are your other disability protection solutions. So the Canadian Pension Plan does provide a taxable benefit after the 4th month of disability, but it is strict. It has strict eligibility requirements and is intended for grave disabilities where there is little hope of recovery. The stringent definition of a disability excludes most people, and the benefit amount is limited. Employment insurance is another way that offers a short-term, 15 weeks only, disability benefit for employees, and qualifications are based on strict criteria. For disabilities lasting longer than 90 days, EI, employment insurance, is of little use, and self-employed people are not eligible. Workers' compensation is also employer-paid benefit covering work-related accidents and sicknesses only. It does not cover accidents or sicknesses outside of the workplace. While the benefits can be substantial, 90% of the income, the workplace restrictions and the possible difficulty in claiming benefits make this a limited solution.
Long-term care insurance can be thought of as a replacement for long-term disability during retirement. This insurance provides cash to pay for additional expenses associated with long-term care needs. You may want to consider purchasing it prior to retirement, so this is a little later in your life, to lock in your health and get lower premiums. Long-term care insurance provides a monthly benefit if you're unable to do 2 of the 6 activities of daily living or suffer from cognitive impairment. The monthly benefit amount you receive depends on where you're receiving care, either at home or a facility. When we come back from the break, we'll talk about the peace of mind life insurance offers.
Hi there, we're back. I'm here with Ella Lang and I'm Terence Vanderwood, and we're talking about how insurance works. We've talked about critical illness, and we've talked about disability insurance. How and when does life insurance come into play is the next on our topic list. So as you age, your life insurance needs may transition from term to permanent insurance. So permanent insurance provides protection for your lifetime. Term insurance covers the short-term need for larger liabilities, which for most people is their mortgages. If you may want to protect your estate from the impact of taxes with permanent insurance, or enhance the amount you give to your beneficiaries or the charity of choice. As individuals' needs upon death fall into 2 categories: those that are always present, like final expenses, taxes, debts, and creating income source for survivors, and those that apply to certain ages and life stages. For example, younger people need to be concerned with children's welfare and mortgage protection, where older people have estate planning or estate equalization needs. So, contrary to popular belief, protection needs do not always evaporate as you get older. Actually, what they do is they evolve and they change shape.
If one were to die prematurely, how much capital would their dependents need to continue to receive an income that they were used to receiving? If one is earning $48,000 a year, you'd need anywhere from $500,000 to $1.2 million to produce a similar income, depending on the investment return you could generate on that capital. That's a huge amount of money, and this is where life insurance becomes important. By providing a sum of money that can be used to purchase an annuity or invested to provide an income, insurance is a cost-effective way of ensuring dependents continue to receive ongoing income, therefore protecting their financial security.
Let's look at a case study. Okay, we've got John and Mary Smith, husband and wife, that decide that if one of them is to die prematurely, the surviving spouse will need 60% of the deceased spouse's income to maintain their quality of life. So again, let's assume, let's say that John is the one who dies. Sorry, John, but you got hit by a bus. He earns $40,000 per year. 60% of that is $24,000. So to replace $24,000 per year to protect Mary's income needs, John and Mary need $40,000 of capital.
That's 400,000.
Sorry, not 40,000. That's $400,000 of capital. And this assumes a rate of return on their investment of 6%. So Mary and John have determined that they also require $170,000 additional dollars to take care of immediate needs, like paying for John's funeral, covering his taxes, paying off the mortgage is another big one, and creating an educational fund for their children. So this means they require $570,000 at the time of John's death to cover immediate needs and to create an investment fund that will produce $24,000 per year for Mary to replace John's income. So how do they get $570,000?
Well, for one thing, they definitely need an insurance needs analysis to determine if they have a shortfall in their plan and by how much, so that a financial planner with an insurance license, like ourselves, can match the appropriate type of insurance to their needs with premiums that fit their budget.
That's right. A comprehensive personal protection program begins with a systematic evaluation that aligns your current situation with both your own and your survivor's needs and goals. So if Mary and John are in their 30s or 40s, they could cover their highest liabilities, like their mortgage, for a 20-year term, which is inexpensive because the younger you are when you apply, the less expensive insurance premiums are. And they could purchase a permanent insurance to cover final taxes and legacies they wish to leave to dependents or charities. We've got another chart for you here. We call it the priority pyramid that sums up the importance of solid risk management, as it is truly the foundation of anyone's financial plan. Setting up wills are part of this process, and once these issues are properly handled with the assistance of the appropriate professionals, one can concentrate on building your net worth, which includes saving for retirement.
We're going to go to a break now, but when we come back, we've got your action items, so stay tuned. Welcome back to the end of this episode of Pure Awesomeness, where Terence and I are hopefully educating you out there about how important and wonderful insurance is to own and have it tailored to your needs. It steps in like a superhero. When times are tough and you have other concerns, money is taken care of, so you can concentrate your time and energy where it counts.
That's right, the insurance superhero, the one that protects you when you're down. Think of it, we pay a lot of insurance as individuals. We all have car insurance. It would be absolutely unthinkable as well as illegal to drive in BC without car insurance. But think about it. Would you take the risk of driving without insurance? Another example, when we go on holidays, what do we buy? Travel insurance. And so that we take the risks out of that. So why would we hesitate to buy proper insurance to cover our own health, our homes, and our children's future, and our loved ones' financial stability?
And get this, you have a 1 in 14 million chance of winning Lotto 649. I don't know what that is right now, $50-60 million. But
$350 billion.
I know, wouldn't that be insane? So 1 in 14 million chance of winning Lotto 649, but a 1 in 3 chance of being disabled for more than 90 days before the age of 65. We're not making these numbers up, people. This is based on stats that we're given in our industry on a regular basis to inform our clients and prospects. So take that seriously. Your action item is to see a professional with a licensed insurance certificate or a provider like ourselves and have a needs analysis done. Choose premiums that fit your budget, and as soon as you can too, because the younger you are, and that means the healthier you are, it will blow your mind as to how affordable insurance can be. It really doesn't have to be a big deal. And if you're a smoker, guess what? That's going to affect your amount of premiums big time. So, quit smoking.
That's right. Great advice. Quit smoking. So again, your action item is to seek the professional from a licensed insurance provider and get yourself an insurance needs analysis. But speaking of the cost of smoking, I have another real world scenario I'd like to share. This is a client of mine who was interested in seeing how much it would cost for her future self per cigarette. So, looking at the graph that should be on your screen now if you're following along on the podcast. If not, if you're listening on the radio show, you can find it on our website, or sorry, not on our website, on our Facebook page of Dollars with Cents. And of course, if you're following along on the podcast, it will be there right now. So looking at the graph, you can see that the cost per package was $14.85. The number of packs per week for this person was 3. So they went through 3 packs a week, which is, I don't know if that's not a smoker, so I don't know what is reasonable, but well, 3 packs doesn't.
Not a pack a day, basically.
Yeah, it's not a pack a day. The cost per week, based on those prices, are $44.55 per week. Cost per month is $178 per month, and the cost per year is $2,316.
Jeez.
So that's $2,316. This client is age 34. We based her retirement at age 65, and so she's got 31 years to go for her retirement. So the estimated cost per cigarette at the $14.95 per pack is 74 cents.
A cigarette.
A cigarette. Mm-hmm. So each cigarette costs 74 cents. So the potential retirement fund based on various annual rates of return. So we took different rates of return to if that money was invested elsewhere, right? So if you took the $2,300 per year and you actually put that into an investment, then the average rate of return we put was 6%, 7%, and 8%. So the opportunity cost from smoking, so how much you would spend on 3 packs a day if you smoked until you were 65, right? It was $2,300 per year. So you would be losing, if you put that away, that $2,300 per year until you're 65, instead of smoking it, at the age 65,
literally.
Yeah, exactly, literally. At the age of 65, if you got a 6% return, you would have $216,000 and $872.
Oh my God!
7%, you'd have $264,000. At 8%, you'd have $323,000.
Can I interject right here?
Yeah.
Can you imagine that money put towards a life insurance policy? As it grows, or a term, you're paying for your term insurance right there. I mean, more than that.
Definitely more than that. So so how much it costs per cigarette for this client when she decides to go and have a cigarette? I said to her, just think of it. At a 6% rate of return, each cigarette costs your future self and you today $70. 70 for every single cigarette. That's how much it costs your future self.
That is amazing, Terence.
So yes, the long-term financial cost of smoking is something that smokers really fail to consider. Oftentimes, smokers realize that it's expensive to come up with the money for pack after pack of cigarettes day after day, but they still fail to consider the long-term financial costs, which again, that's what we're focusing on. So worrying about how to pay for the next pack of cigarettes is short-term thinking. Worrying about how much your financial future costs for those packs of cigarettes is long-term thinking. People who are wealthy or are on their way to becoming wealthy tend to think long-term. This projection, as I stated, illustrates the value of smoking just one less cigarette per year and the savings used for the retirement plan.
Awesome, Terence. I bet you nobody's ever put it in that perspective. For you guys out there, think about it. Think about it really hard. And again, if you've missed this show and you want to see that graph, pick it up on Facebook, Dollars with Sense to Read, and reread it, and get it out there and tell your friends. Anybody who smokes, how much is that costing your future self? That's it for this week. We'd like to give our wonderful Tri-City radio station, CKPM 98.7 FM, a big hug over the waves for broadcasting this show today. Send us your questions and comments. You know you can always do that on 2 financialgurus@gmail.com. You can call Terence and I at 778-879-0820. Don't be shy. We love to hear from you. And we will catch you guys next week on Dollars with Sense. Have a great week, everybody.